You know, Paul, you've obviously been covering this space for a long time. You say this is potentially the most interesting market you've seen in 30 years. What do you mean by that?
What we're saying is it's the most profitable that we've ever seen for oil and gas and refining companies. So, there's just a multifaceted element to this. And you mentioned coal. That's also raging. And what we're getting here is companies that are maintaining capital discipline and just making enormous free cash flow. So it's the most profitable environment I've seen in 30 years covering oil.
Is it sustainable, Paul? It was really fascinating to hear Brent Thill. He's a technology analyst at Jefferies. Last hour, he was talking about how clients don't want to hear about tech. They want to go to energy. They want to go to consumer staples. And that's quite a comeuppance for the best performing sector over the past decade.
Yeah, it is. I mean, it's obviously a huge change. Is it sustainable? Well, obviously, it becomes an economic question. At the moment, we're not seeing the demand destruction. Again, you referenced that. Essentially, the price is trying to encourage more supply or less demand. And today, OPEC announced, an increased production target. But in reality, over the past month, against a 400,000 barrel increment target, they added 30,000 barrels to give you an idea of just how undersupplied these markets are. So it's extremely powerful. We like Chesapeake on the gas side, Antero, and then almost any of the oil companies. They've all had very good results this week, especially when you combine, for example, refining and Exxon and some of the refiners. It's a remarkable environment.
When we're looking at the global oil picture, we're obviously discussing Europe cutting off the import of Russian oil. What does that mean, big picture?
It's a huge deal. And in fact, OPEC has said they think there's 2 million barrels a day, too much oil in the second half, but they're still including Russia in their numbers, which is absolutely staggering. Now, Russia, as you know, is a major natural gas and oil exporter. And the loss of Russia, which is going to get more and more fed through into markets, it takes weeks and months. But ultimately, as you said, yesterday, the EU announcing that they're going to block oil and gas from Russia over the next year is a very, very big deal. And it's enormously important for American exporters of both oil and natural gas.
Paul, when people come into this space now, should they be putting money? I mean, you've mentioned some of the plays you like in the past, but broadly speaking, are there any stocks you think here look overvalued, richly valued? You know what I mean? Like any places that kind of the tourist investor might get burned?
Well, we're talking about oil trying to get to 10% of the S&P, and we're at 4%. So there really isn't. I don't personally love the service companies. We're seeing such great capital discipline from the E&P companies and the big oils. Normally, historically, you could look for the service companies to get their revenue as a multiplier of revenues for the E&Ps. If they got $1 through the door, they would spend $1.20 drilling wells, and they're just not doing that. They're now at a point where they're under 50% in many cases, even less of their cash flow is actually going on incremental wells. And they're saying they really don't have the people, the steel, it's very difficult for them to add any real capacity in terms of additional production. So as a result, the service companies are the one area that we're less favorable towards: the Schlumbergers, the Halliburtons, the Baker Hughes.
Paul, what about the moves that we've seen in natural gas? Pippa Stevens pointed out the big moves that we've seen in the last week, that perhaps in some cases you might see companies swapping out for coal, but that's also moving higher in the price action. Can you make some money off of that play as well?
Yeah, as I mentioned, I mean, we love Chesapeake, Antero, Tourmaline in Canada are all, great plays. There's issues with some of the Marcellus plays because they are infrastructure constrained. So what we try and do is buy the names that don't have that problem. And a name like Chesapeake, which is in the growth area of natural gas, because natural gas production is not growing. That's one of the worrying things. We're at $8.50 per MMBTU, and we're not seeing significant growth here from the producers outside the Haynesville. Chesapeake's a great play, and there's several companies here where they've come through bankruptcy. Obviously, there's a trailing, concern about the company because it's previously been bankrupt. But the fact of the matter is, they have very clean balance sheets now. And so this is all free cash flow back to shareholders, buybacks, dividends, everything that the NASDAQ doesn't offer you.